Happy Sunday to you all. And hello, Propenomix people, and welcome to another supplement live. And this week's was called Hold On, which, as you'll quickly find out, is a reference to the interest rates. So, as you'll know, if you've listened before, I always like to start with a quote, but can I just say, this week's video is extremely important. There's a message in there that I have been working on, crystallizing, disseminating through the talks that I've done over the past few weeks. It's been something that's been forming in my mind for a number of months now, ever since the yield curve took the shape that it has done at the moment, and took me a while to figure out the puzzle. Wanted to make sure I was correct before I turned this into something very firm. But this particular video will be one of the most important, if not the most important, that I put out, certainly in 2025, unless some significant black swan happens. So I advise you to stick with it and get there all the way to the end. And if you haven't already, give me a like on the video, a subscribe on the YouTube channel. It helps massively, helps move the channel forward lots and lots, and will help me achieve some of the things I'd like to achieve in the medium and long run with the channel. And also leave me a comment. I always reply to the comments on the YouTube as well. So thank you. This week's quote is, "It all comes down to interest rates. As an investor, all you're doing is putting up a lump sum payment for a future cash flow." And that's from Ray Dalio, macro investor of note, of significant note, I would say. And why are we talking about interest rates particularly this week? Well, both the Federal Reserve in the US and the Bank of England had a rate setting meeting. But before we go in full throttle, I just want to let you know, Rod and I are running another workshop in July, Thursday the 3rd, couple of weeks away. Joint ventures and mergers and acquisitions this time around, always a highly popular one. A whistle-stop tour of the agenda, market dynamics, JV opportunities, legal structuring for property businesses, pros and cons of limited companies, all about share classes, shareholder agreements, and sustainable JV models. Just remember, just like with any sort of contract, you can achieve anything you want to if you understand these things properly, and you can brief your advisors accordingly. Dive into capital structuring, compare debt to equity, managing risk, and understanding personal guarantees. Get insight into property M&A, from due diligence to asset versus share purchases. Apply concepts through 2 in-depth case studies, one about acquiring an asset-backed property company and one about navigating a distressed business sale. Understand strategic disposals, company wind-ups, and how to negotiate under pressure while maximising value. Don't miss the early bird tickets. 10% discount still available, only a few days left, and they are selling quickly at bit.ly/PBWSEVEN. And the link is in the show notes and the comments to this video, wherever you're watching. So, straight onto my Trump Watch segment then, which looks like it's going to be a regular segment up until we get to the end of 2028, apart from anything else. First 10 days of July have been even more volatile, really, because aside from the 90-day tariff period coming to an end, which no one yet is really talking about, we're only sort of a fortnight away from this period, right, or 3 weeks away. We've also got the up to 2 weeks period Mr. Trump has designated for making a strike against Iran's nuclear facilities. Indeed, as I'm recording this, I've seen some headlines this morning suggesting that the US have launched strikes against Iran. So I'm not sure if these delaying tactics work again and again, especially when everybody can see them on the world stage and you're using them in every negotiation. So at some point, a bluff was always going to be called. And I said, when I wrote this, that point was coming within the next 2 weeks, and it looks like it might already have come. So hold on to your hats. And then for a bit of Trump distraction, there's been some more chat about the fraud that Trump has been going on about since the 2020 election. He doesn't seem to want to let that one lie. He's now conjoining that with the story that Biden wasn't fit to be president at the time. I'm not sure everybody believes that, really. I think at the time he was probably okay, but there was concerns over his age, which then got significantly advanced, and there was probably significant evidence of, apart from anything else, Alzheimer's/dementia late in the term that was obviously covered up. So there's an element to which he had a point, but in 2020 was that point valid? I'm not so sure that it was. And then same old tactics. He's given another 90-day extension to ByteDance to get rid of TikTok to a US buyer before it faces a ban. So that ban just keeps getting kicked down the road. Trump launched Trump Mobile, the world's first influencer presidency, continues to find ways to monetize itself. So that's nice. And he also got legal authorization to crack on with National Guard deployment in California, overruling the governor. We're not really sure whether that's more about him upsetting the governor and the Democrats in general, or whether he really strongly feels he needed to get involved there. But what's the impact of his actions, really? Well, it's primarily volatility, mostly in the stock market, but also in the oil price, as a dip in the price that had come along was reversed very quickly. Major economic news in the US on the week was retail sales down year on year, rates held by the Fed, housing starts below expectations, and a 15-year mortgage rate close to 6%, with the 30-year nearer to 7%. It's low 6.8 at the moment. So perhaps we should be thankful for what we're paying over here at the moment. Those mortgage payments are significantly punitive, of course. And I'll go more into the longer-dated bonds and gilts when I round up the Bank of England meeting from this week and get into my little story about the yield curve later on. So switching to the real-time UK property market, Chris Watkin is like the mailman, and week 23 is in the postbox. Listings printed 37,600, a little bit down on last week's 39,300, still 5% higher than 2024 year to date, still 8% higher than the pre-pandemic market. So clipping back just a tiny bit, but my old 10% more stock than a typical market ready reckoner is still close enough, I think. 27,400 price reductions, 14% of all stock on the market reduced in May compared to last year's 12.1. That was the average monthly for the year. April was 13.4 and the 5-year average is 10.6. So we're seeing more stock, more reductions, both absolutely and in percentage terms as well. 32% more reductions than the 5-year average. If you increase 10.6 to 14%, that's a 32% increase. 25% more reduced properties than a normal market is what I'm going with. It's a pretty good ready reckoner. The 5-year average, I'm not deeply happy with it because we had that distorted market of 2021 and 2022. Did it balance out everything that's happened? I'm not really sure that it did. Stamp duty holidays, we've had multiple ones. It's not the greatest, but it's the best proxy we've got at the moment. And what do we know? 1 in 7 properties that are on the market are being reduced every month. 28,100 homes sold subject to contract. I'd still say the market is healthy. Lots of headlines disagree with me at the moment. There's been raining from the skies. It's the worst market since XYZ. I've had some ridiculous comments on my LinkedIn about how I'm wrong, and buyer demand ultimately is up. I'm not sure why people are struggling with that fact, and it would be up because it was subdued in 2023. It takes a little while for confidence to repair. It's not like people's confidence has repaired yet. Consumer confidence is still low, but it's improving. It improved again a little bit this week. Savings rates are still very high, which means people are nervous about the future. This isn't a confident market, but it's definitely not some kind of amazing buyer's market. It might be if you're buying properties over £1 million in the south of England. Then it's a buyer's market. I think it probably is, but just don't believe what you read too much on this front because there's a lot of hogwash out there in the press at the moment. I've shared an article on my LinkedIn from The Guardian, not that I was specifically picking on The Guardian, but it was a pretty good manifestation of all the things I'm saying, the typical media and hogwash. And of course, The Guardian are self-interested in wanting house prices to go down. They do think that would be a good thing for the country. I could disagree with them all day on that one, but that's a little segue there. Healthy market, sold subject to contracts, 8% up this year, 16% up on the pre-pandemic market, still nearly at pace with 2022, which at this point in 22, we were still in a very hot market indeed. We went into June with 756,675 homes on the market. As the market then got stickier before the pandemic, the number was more like 660,000. A seller's market is going to be more like under 600,000, right? A buyer's market, well, it's all on demand to a large extent, right? But if there's no stock, it ultimately, unless there's no stock and no demand, which would be unusual, but I guess there were points in COVID where that was the case, but there were no transactions going on. At the end of May 2024, there were 694,000 on the market. So we're not sort of drastically overblown, but we are higher than that. We had a lumpy trend upwards in just May, sort of 45,000 extra homes going on the market. And it's going to be hard for prices to move forward significantly in the coming months. I think this flat feeling will manifest in a pretty steady market without much excitement as we head into summer proper. All we've seen over the last few months is a bit of adjustment around and about after stamp duty after a fairly significant stamp duty change, just because it affects so very many of the transactions that are undertaken in the UK. And actually, I commented that in April, stamp duty take was only down 0.8% on March. In May, stamp duty take was down 30%. So obviously some of that take in April was based on material completions that were achieved by the 31st of March, you can assume, but the returns submitted in April, and that must have been how it worked. HMRC don't publish the data in that sort of level of detail, but that's what I'm reading into it. I think flat market, but the first market that sees less stock rather than more on it before sort of November will be a bit of a tell. We don't know in August. We've got a lot on the market at the moment. It might be a quieter August. Couldn't read too much into it if that month was August. But let's see what happens in the lead up to November. But really, we're still not telling the real story. People aren't telling the real story, which is landlords are exiting. They're never spoken about truth, right? They're exiting. And that's why these properties are on the market. We've seen numerous bits of analysis from Rightmove and Zoopla over the past 18 months or so, which have said 1 in 5 on properties on the market at the moment are ex-rentals, as in were rented through that portal within the last 4 or 5 years is the proxy they've tended to have used, whereas fewer than 10% of what's being bought is actually being bought to let. So that tells you where the disposal, certainly of the leveraged properties, doesn't tell us anything about properties that are bought or sold that are cash owned. And of course, there isn't a huge driver to sell cash owned properties as a general rule, because you're not getting whacked by Section 24 if you've got them in your personal name, because presumably you're not relying on leverage to try and generate business level returns. You're happy with a few percent net yield per year, and you're happy with a few percent capital growth per year on average, or that's what you're hoping for. Pretty ordinary stuff, nothing you could sort of really build wealth on the back of, but something you could really protect your wealth on the back of, which of course a lot of people use property for that purpose. And a lot of people who've had a house they've owned once and then they lived in and then they moved, but they didn't sell their previous house. Lots of people have done that and continued paying the mortgage down in a fairly systematic fashion, for example, right? So, 40,000 homes extra on the market in May. May 2018 looked a bit like that, but the typical year looks more like 10 or 15,000. I'm not reading too much into 1 month. Maybe there was a bit of a pause in April to let the market sort of catch up for stamp, and then people decided to go on in May. I don't know, but you can't deny the 756,000 homes on the market is the most for many years. And if buyers don't match the sellers, and right, I'll talk about this in the Rightmove section later on, but buyer demand is still up. It's just that supply is up more. That's the key thing to understand. So am I calling for a drop in pricing? No, I'm just not expecting much of an increase over the next few months. Not even really keeping up with wages and inflation, which is still going to be going forward. So I'm expecting fairly flat outputs from the Halifax and Nationwide indices over the coming 3 months, right? And I think this is strengthened by other price news this week from Rightmove, as I'll examine later on. Fall throughs are still below the 7-year average, 22.8%. Last week was 23.5. Average is just about 24.2. So very, very close to that number, really. Net sales, 6% up on last year, 11.4% up on pre-pandemic. Not quite those 2022 levels, but of course that stamp cliff will have forced a few transactions out of bed. And as the year progresses, in the absence of really significant shocks, policy shocks, things like that, things will likely catch up because transactions were significantly disturbed by that 2022 budget, of course, and the bond markets and their reaction to it in comparison. So I always give Chris a weekly shout out here, Chris Watkin, because he's more prolific than just this epic tome he releases weekly on the UK property market. He's got great stats on a regular basis. Drop him a like, a subscribe, and all the rest of it, and some kind words for his content creation. If you're in the industry and want support in growing your business or to become a more effective communicator or be more in touch with your local market, that's his core business, so give him a shout. The article's published on the Property Industry Eye website and the video on his YouTube channel at Christopher Watkin. Okay, what's under the macro scope this week? Well, inflation is up, first of all, my staple for the last 4.5 years. The ONS private rents and house prices report needs a look. Rightmove caused a fuss with their asking prices report this week as well, so that squeezes into the ONS slot there. UK Finance have also published some interest-only mortgage data, and my report on the most recently available quarter is also outstanding due to other matters have squeezed it out of late. So let's catch up on all of that. And after that, I concentrate on the gilts and swaps as will remain a mainstay for many coming months and years. Okay, inflation. Yuck. Well, nothing of any real surprise, nothing I haven't been saying for a long time. CPI dipped under 3%, and in fact it went under 2% at one point in 2024, but really it was just anomalous, simply because those ridiculous energy prices came back somewhere near to earth, although nowhere near where they were before the pandemic for the UK. Core inflation, which is a much better gauge, has not been under 3% since September 2021. And as I keep saying, 3% is the new 2%, and it really should be the government target, and is the accepted number by both households and businesses in their own calculations and expectations. Then there was one more embarrassing egg on face moment for the ONS, which I'm tired of reporting on these, to be honest. But recently they admitted April's inflation was 3.4, not 3.5, primarily blamed on the government reporting the wrong number of vehicles being subject to paying car tax in April. Where do you start? So, in theory, the May print of 3.4% was a hold rather than a drop from 3.5. But importantly, all the numbers hit the economic consensus. So it meant no real change in the gilt markets. In fact, core inflation at 3.5, which is down from April's 3.8, was 0.1 below the forecast consensus. So be thankful for small mercies and all that. CPIH, which the ONS prefers, is still 4%, down from 4.1 in April. Remember, this is CPI, including the cost of housing, much more equivalent to the American CPI, although, confusingly, the American CPI is not the metric that the Federal Reserve follows, because the Federal Reserve prefers PCE, so more about consumer expenditure than it is about the Consumer Prices Index. Limited difference, but PCE, again, tends to be even lower. So cynically, you might say, well, it's handy that PCE is lower than CPI when inflation helps the government. But, who am I to make these assertions? Month on month CPIH was 0.2, which is much more normalised after awful April. And CPI was the same 0.2 month on month. Downwards contributions were from transport, but more worryingly, upwards contributions were primarily from food and then furniture or household goods. So core CPIH is still above 4. It's 4.2 for May. It was 4.5 in April. Core CPI was 3.5, down from 3.8. But right direction, but core metric far too high still for a 2% world. Services inflation, well, CPIH terms 5.3, CPI terms 4.7. But below 5% is quite a good result in recent years for services inflation. But remember, that makes up nearly 50% of the CPI or CPIH numbers of the entire economy. So significant driver services inflation. And how can they not go up with minimum wage up 6.7, with national insurance? All the stuff we've been talking about for 8 months now since the budget. OOH, which is the owner-occupier measure of housing, which is basically the bit they inject into CPI to get CPIH, is continuing a slow downward trend, but still printed 6.7% for May, down from 6.9 in April, and from its high of 8% at the turn of 24-25. So it's acceptable, but it's still far too high, of course, and it's still crushing households when their time comes to get either their rent rise or their refixed mortgage. Owner-occupier housing, 17% of CPIH, ONS told us this month. I don't think they've ever told us that before, but it's nice to know. So about 1/6 of all true inflation as the ONS sees it, because they prefer to talk about CPIH as they feel households have household costs, which, let's face it, is pretty reasonable. But of course, what government would look and go, oh, technically we need to change CPI to CPIH. Well, that's a good idea. Is it higher? Yes, it is at the moment. Normally it's lower, but at the moment it's higher. Well, let's just wait till it's lower again then, and we'll do it in a few years' time. Food ex-alcohol, 4.4% was a huge jump of 1% since April. So it went from 3.4 to 4.4 on food inflation. So for whatever reason, we waited till May to really raise the prices on the supermarket shelves. Maybe it's just the supply chains and the way it all worked. Well, there's no doubt national insurance and minimum wage rises are the primary drivers of that. And it really is the nastiest inflation, food inflation, because it hits the lowest earning households the hardest. It's the highest print since Feb 2024, when it was on its way down from a peak of 19.2. Yes, you did hear that right. 19.2%. That peak was March 2023. Now, the root causes in May were sugar and meat, apparently. But food alone contributed 0.1 to the total inflation rate for May 2025 in just 1 month. And as a percentage of the overall figure, it contributed 0.4% to CPIH for the year. So really significant just in food. Housing and household services alone contributed more than 2% to the CPIH inflation rate in May 2025, 2.04 just from housing and household services into CPIH. That was its biggest contribution since mid-2023. And I would presume that energy bills were still driving it primarily at that point. So on their own, household and household services are up more than the entire target the government sets for the Bank of England's inflation management measures. Well, get your head around that. The standard international comparison shows that we're doing worse than everybody else on the inflation front. 3.4 is a standout, with no one else even above 2.5 in terms of our standard peers, the EU, the US, Germany, France, etc. RPI was 4.3 for those who have it in their leases, and price woe isn't going away anytime soon. And the Bank of England are forecasting around 3.75% for Q3 2025. Just as a reminder, though, the second biggest beneficiary of inflation is the leveraged property investor, just one behind the government, because, boy, have they got some leverage, right? Okay, house price indices for the week then. Let's start with the ONS PIPR, which is Private Price Index of Private Rents, and house prices, their report. Now, always confusing, they report on rents more recently, so they report on rents in May, whilst they report on house prices in April. Rents up 7% to May, which is down from 7.4 and coming back towards earth. It has been in the nines. But remember, they're surveying existing and new rents at the same time. Big sample, 550,000 tenancies from a company called Dataloft. Really robust data sample. Can't argue with the validity of it, I don't think. So the split is roughly 4 existing rents to every 1 new rent, roughly. UK house price index also returned to normality. On reflection, I should really have commented on the large spike for March's prices, but I didn't. It completely normalised and went the other way on April's prices, according to the ONS. So if I give you a summary of the last 4 months reported, January up 4.1% year on year, sounds about right. February up 5.6%, sounds a bit salty. March up 7% year on year, that should have been the red flag, really. April up 3.5% year on year. So if you look at January 4.1, April 3.5, there's no fuss to be made there, particularly a little bit of an adjustment. But once again, the stamp duty deadlines just mess with the figures. 3.5 is the lowest print since November 24, but we're not writing home about that really. Just confirmation that sideways market has dominated the first half of 2025. Otherwise, I've said before, when you split it down regionally, a much more accurate statement would be the buoyant northern market in cheaper stock has counterbalanced an anemic southern market with more expensive stock. The driver of most of that, interest rates, other than anything else, right? Regional breakdowns in the report play out just as they have been, really. But the Northeast are now the big leaders in the regional capital growth stakes, up 6.4 year on year for April. Southwest lagging at 0.9 year on year. But London's up to 3.3 year on year. Presumably those much higher prices quite a bit less influenced by a comparatively small shift in stamp duty, because it's £2.5 for every property at 250 grand and above, right? So if you're way above that and you're into the 600s on your average transaction, you know, some of the transactions in London can be really, really chunky. It's not going to have made such a difference compared to a 250 grand house in the East Midlands, which is now 1% more expensive. But it's not just that 1% more expensive. You've got to find that 2.5 grand extra if you're moving. You've got to find that as cash. A lot of it you might be borrowing. Average, we'll see later on. Average home mover is borrowing about 65%. So, and a lot of the rest of it is coming from their equity in the home that they're selling. They're not going to create a new deposit, you know, so that's important to understand. But look, don't waste a lot of energy on the clickbait headlines and the YouTube videos that are out there saying the sky is falling and all the rest of it. It's just a bit of stamp duty noise at the moment. And this is the beauty of looking at the real-time information in detail. I'm very, very confident that I'm correct here. So, and rents-wise, the Northeast is winning again, 9.7% up year on year. London's coming back towards the mean, but it's still up 7.7 year on year. And Yorkshire is still lagging at 3.7. But the South is still losing to the North here in terms of rent increase percentages, and the Midlands is in the middle. Looks quite a lot like the capital growth charts do as a whole. And Rightmove threw a spanner into the works here because they're minus 0.3% month on month for June, which they point out is seasonally unusual, but still very much a stamp duty noise symptom in my opinion. And they see asking prices up only 0.8% year on year on Rightmove. I think you feed this into the flat market theory over the next few months. But flat markets are fantastic to trade in. I wanted to say at this point, right? Uncertainty means buyers calm down or they hesitate. Vendors who want to sell cannot make a bullish case for a great market. All roads lead to Rome for the calm and measured investor here. 2019's flat market was one of the best we've ever traded in my group. So to give you a comparison here as well, the average UK price according to the ONS is £265,000. The average UK asking price, according to Rightmove, is £378,240. So, I mean, just a gigantic difference, over 100k difference between those two. 40% difference between the average asking price and the average house price. Almost insane, almost two different markets, really. And Rightmove draw the same conclusions as me. Higher priced southern regions and the capital have seen larger price drops. They blame the higher SDLT, but I just think it's continuation of the trend that's been going on since mortgage rates normalised. And they report on more stock being available, as I've been doing thanks to Chris's real-time data, for months and years now. They describe buyers as resilient, and the key core economics data here is buyer demand up 3%, but supply up 11%. But I'm pleased to see the advice I've been giving for months in print here for Rightmove. Simply proves that real-time analysis is the way forward. I quote, with buyer choice so high, the market is very price sensitive. So pricing realistically is key to selling. Now, if Chris was here, he would also say, because he has a big bugbear about this, and I understand it, that ultimately we have to be very cautious of overvaluing. Estate agents, especially corporates, are trained to overvalue to get the instruction. And there's no time where it's more damaging to overvalue a property than in this market today. If you want to sell, you must price realistically. If you're going to go busting ceiling prices in an area, and there are plenty of flippers, developers who do things like that all the time, right, your product's going to have to be absolutely on point. It doesn't mean the best of the best of the best. It means locally appropriate for the best to bust a ceiling. It's not a good time to be busting a ceiling, in my opinion, because there's so much on the market. But there's always people for the very best stock in the market. So if you do prime, you're a lot better than I am at that stuff anyway, so why listen to me, right? Here's a stat now that Chris would also love. Rightmove data shows that homes which attract an inquiry on the first day of marketing are 22% more likely to find a buyer than homes which take more than 2 weeks to receive their first inquiry. And as I say, he hates the overvaluing. I think it's the cancer of the industry, I really do. And that sort of stat shows how damaging it can be to unsuspecting vendors. So Rightmove striate things into 3 categories: first timers, second steppers, and top of the ladder, right? Top of the ladder, average asking price about 700 grand, right? The minus 0.4 in first time buyers will be concerning for new build developers, but the minus 0.8 at the top of the ladder absolutely emphasises what I'm hearing from many when they're trying to sell expensive units at the moment. It's very difficult. Middle of the road, 350 grand stock, much less problematic. Asking prices down 0.1 on the month on Rightmove. And Rightmove recognised that the June blip is more strength than expected in April and May, and they're just seeing this as a wave that's averaging out after stamp duty. So, as I'd already said, although that wasn't what they decided to quote, but it looks like a manifestation of what I say very often. The market moves very slowly, which is one of the reasons why I put in the amount of effort that I do to make sure that in my group and all of the listeners to this podcast can benefit in the now rather than waiting for the headlines to report on what's already been blindingly obvious for weeks, months, and sometimes years. There's no point being able to look back on what you might have done. It's no good to anybody. So Rightmove have a weekly mortgage tracker, which is pretty good, compared to the Bank of England drawn mortgage rate. They say 4.61 as the average 5-year fix. Remember, that's not best price, that's average. And they say 12 months ago it was 5.04. So they say it's only slightly down, but I think, I think it's pretty good, really. That's like 43 basis points down. Pretty good, given that yields haven't moved a lot. And in fact, the only thing that has moved is the premium and the discount over the swap rate, which we will get into when I get into the deep dive. But days to secure a buyer metric, they have this in their report. It's a good little temperature gauge of the market. Stayed at 59 in April, when the normal months in the past 12 have printed 60 to 65. So April was still warm neutral. We haven't got beyond that yet for Rightmove. They obviously lag a couple of months behind them when they do that one, but affordability still looks good on a recent history basis, as the Rightmove graphs show. So although that would upset most apple carts in the media and is contrary to some comments I've received, it is the fact of the matter, so that does rather help. So what about the mortgage data? Well, UK finance isn't fast, but what they produce is quite rich, so it's always worth a look. At the end of 2024, there were 541,000 interest-only homeowner mortgages outstanding, 18.5% down on the 2023 end number. There were also 174,000 part and part or partial amortization mortgages outstanding, 13% down. So the total interest-only stock is down 78% since 2012, when we first collected the data, when the UK Finance first collected the data, and 61% in value. So the bigger interest-only loans are still out there by the sounds of it. Interest-only loans are over 75% LTV, fell by 25.7% in the year, and are now only 5% of the total IO stock, compared to 36% in 2012. Interest-only loans maturing by 2027 shrank by 67,000 to 120,000 loans, down 35.8%. The UK Finance Director of Mortgages said customers with interest-only continued to pay on or ahead of schedule, 150,000 fewer interest-only loans on the books than the year before. He notes that very few don't pay on maturity, and most of the ones that don't pay on maturity pay within a few months of the end of the term. What's still outstanding? 116 billion interest-only, 39 billion part and part. 570,000 of these mortgages expiring in 2028 or after, and 24,000 of them are over term, 4 billion quid's worth. The majority sit below 50% loan to value. Whilst on the UK Finance bus, though, worth looking at their recent output as well. So they published some Q1 data, and according to them, the average first-time buyer takes a loan to value of 77.1% and a loan to income multiple of 3.58. Home movers take an average loan to value of 64.9 and have a loan to income of 3.21. So not dramatically lower, you would know. The size of those two loan markets in Q1 of 25 was roughly equivalent. 22.7 billion advanced to first-time buyers, 24 billion advanced to movers. UKF have revised their website, including putting some key data behind a fence, which looks difficult to hop over if you are not a bank or in the finance industry, which is unfortunate, but their reports seem to have stepped up several notches. And with that in mind, I'll be back to their website to look at some of the more recent reports in more detail over coming weeks and months. But just quickly first, I'm going to look at their most recent report on arrears and possessions. So this tells the tale of the tape, really. Arrears have trended downwards, still down 2% on the previous quarter, down 6% in the buy-to-let sector. This is mortgages that owe more than 2.5% of their balance. In homeowners, the figure is 1.03% of mortgages in arrears. In buy-to-let, it's 0.61. So pretty low by historical standards. You get into the multiple percentages in problematic times like 2009, for example. But possessions are up 18% for homeowners, 16% for buy-to-let, but below their long-term average. Typical part of the cycle. Arrears were going upwards, possessions then take a while to catch up. Possessions trend upwards now, but arrears have trended down for a few quarters now. So soon possessions will trend downwards again. To put into real numbers context, 810 buy-to-lets were repossessed in quarter 1 2025. Okay, the gilts. One of my favourite sort of weeks, really. We opened at 4.076 yield for the week on the 5-year gilt on Monday. We closed at 4.046, a small down week. Thursday's close was 4.035, still above that elusive 4%, which again we flirted with the underside of briefly this week near Thursday's close, but we didn't get there. The inflation figures did very little as we were so near to consensus, so nothing really to write home about. Thursday's swap close was 3.702. The discount from the 5-year gilt yield was 33.3 basis points, which has become our standard in recent months or for over a year now. 1 month ago, the 5-year swap was 3.847% yield. 1 year ago, it was 3.823 for some recent historical context. And that also makes that Rightmove mortgage average rate look a bit strange, really, because a year ago, the swap was only, 0.12 more expensive, but the average mortgage was 0.43 more expensive. So obviously competition in the market is strong at the moment, and there's some real competition going on because margins must be squeezed compared to where they were last year. And maybe there's just more pressure on banks to put lower rates out because the base rate is lower, even though it doesn't really work like that, although there's much more about that in the deep dive. So our best guess of limited company mortgage debt sticks at 5.7. My safe range of stacking deals at 6%, that's what I do at the moment, is a realistic one to work from, right? So once again, I've got no real choice in the deep dive this week because I've got to put you in the picture of what's formed more recently as a firmer view in my mind, because we've been largely ignoring a story that's in front of our eyes, and I'm not challenging enough people. So since 2023, apart from a period in the summer when I said, look, it might be an idea to wait a few weeks or a month to wait for the mortgage rates to calm down, that was the top of the curve, even higher than the 5-year yields when Liz Truss was in charge and helped to deliver that cataclysmically terrible budget. Most of the time I've been saying, don't wait for rates. And I still get comments from people saying, I've waited 3 years to refinance this, and it's cost them so much money to wait, and they're not listening to me, I'm afraid. And I've got to be more emphatic about this. And I've got to tell you a story, and I'm going to try and build this into a picture, because it's not the most engaging, it's not the easiest topic to understand, the yield curve, but it's one of the most important things, as I've said at the start of the video, that I will talk about this year. So my recent LinkedIn poll suggested people thought it was about a 50-50 between a cut and a hold at this meeting. But at the top level, it was a very unsurprising result. Almost everybody figured it would be a hold. I would have thought 7-2 would be the vote. I had it a 98% chance of a hold. I would have been very, very, very surprised had they cut the rate. But the individual voting moved a little bit away from my expectations. I like to try and get the correct score prediction right, and I was wrong by 1 vote. So just a reminder, there are 9 people on the committee at the bank. 5 are internal, 4 are external. We know now we have 2 committed doves. Remember, they're people who want to get the interest rate down, want to loosen things on the economy, think that it's important for consumption, confidence, things like that, right? We've seen enough votes from Professor Alan Taylor now to class him as a dove, because he only joined the committee back in September 2024. And any leanings that the new members tend to have, he's an external, by the way, are largely sort of state secrets almost, as far as what you can find on the interweb. But I've seen enough downvotes through now to be confident in the classification of Professor Taylor as a committed dove. Dr. Dingra has voted down or hold ever since the rates reached 3%, with her primary concern being an anemic economy. And you can see her point to an extent. But what wasn't expected was the crossing of the floor by Dave Ramsden. He's an internal member, as I say, Deputy Governor of Markets and Banking. But perhaps I should have expected it, because he did the same thing. He was the first to cross the floor to join Dingra in voting for cuts back in 2024, before Professor Taylor joined the MPC. However, it was such an obvious hold, I was legitimately surprised, even though I would have had him at sort of 75% hold, 25% cut, if I'd given a price on him individually beforehand, simply because of this previous form. 6.3 was enough for the markets to see it and move the probability of an August cut to 80% from 60% before the meeting. I'd bet against the 80% at that price, to be honest, although I do think a cut is more likely than not. There's lots to happen in July, referring back to my Trump watch section, and bond markets are already jittery. So this is well justified, and we are expecting to see lower inflation soon, remember. I'm not so convinced, but they get into the reasons in the report, and it again, as usual, they tell a pretty good narrative, which you need the central bank to do to inspire confidence. But for me, it's closer to 50-50 than 80-20. That's just my point of view. Maybe 60-40, 55-45. But anyway, as so often these days, did it move the needle in the gilt markets and mortgage markets? Not at all. As we already know, not a tiny shred. They traded as they had done all week, pretty much, right? And sometimes a vote can, there have been meetings recently where they've moved the yields more like 10 and 15 basis points. Didn't move a jot, right? But these filler meetings, as I'd call them, are filling in between the quarterly report meetings. So they're not overly substantial. There's no new formal forecast data injected, although, of course, the bank does robustly consider developments since the last meeting. And indeed, their summary of these developments was that UK-weighted global GDP had grown as forecast. Tariffs remain uncertain. GDP data have been impacted by tariffs, positively in the UK and the EU, negatively in the US because of Q1 stockpiling. US inflation was down a little more than expected. UK wage growth and inflation rate was remaining higher than expected. They also noted a 26% increase in the oil price, and gas spot prices up 11%. And this is what has put a forecasted cut again in the price caps in October, Remember, we've already got a cut enshrined for the 1st of July, but October, that's already moving. And what was looking like it was going to be another cut is now looking like an increase, thanks to what's going on in the Middle East, right? The banknotes, flat yields, recovering equities, a weaker dollar, as we've talked about a little bit, and the Fed's hold of their rates. They also noted higher expectations for inflation from the bank's survey participants, although they note that the median respondent expects inflation to be 2% at the end of the forecast period. They've revised their forecast for Q2 GDP growth to 0.25%. I still think that's wrong, but I seem to be alone at the moment in predicting minus 0.1 to 0.1 as a much more accurate range than people like NISA and people like the bank are predicting. You might think, well, there's not a lot in it, but we're talking billions of pounds with every 0.1%. So it's fairly important to be pedantic, I would argue. They note the weak PMIs I've talked about a number of times, and the poor quality data from the ONS, once again, I'm afraid, particularly on jobs numbers. But just as I did last week in the supplement, they flagged the 109,000 May contraction of payroll employees, which, remember, is an estimate, but they did point out a pretty big number, but not a certain one until next month's figures are out. They also noted, as I did, lots of surveys, including the KPMG REC survey, which is one of the most respected ones, one I report on sometimes on occasion, have been noting lower jobs for some time. They're holding on to the 3.5% to 4% for wage rises by the end of the year, which has been predicted by the decision maker panel. Remember, that will be private sector, obviously, usually pretty accurate. But employers need to get on with getting it down to there, really. It looks tougher than expected at this point, with rises still being north of 5% as I'm talking today. The NI shock factor might sort this out on its own, manifesting over the next few months. However, lots of bigger businesses set next year's pay much earlier than a smaller business would do in a sort of review and that sort of situation. So they must be driving towards that sort of number, I guess. They're not usually wrong in that department. They also mentioned business expectations of their own price inflation of 3.7%. So businesses think their products will be 3.7% more expensive in 12 months' time. And they expect CPI in 12 months' time to be 3.2. So you see, they're still batting high. They're still batting above 3 for CPI. There's a clear focus on the weakening labour market, right? And that being the primary driver for the August cut. They're banging on about moderating wage increases. I haven't seen too much real evidence of that, if I'm honest with you. It sounds like something they want to say rather than something that's truly backed up by the numbers. But the panel hasn't changed their mind and is still saying 3.5% to 4% for the wages. And I guess that would justify the decision if you're saying this is what the decision maker panel is saying. That panel's pretty accurate when you look back historically, unless there's a black swan event, which you can understand, right? The bank now sees 3.5% inflation in the second half of the year before falling back towards the target from next year. Well, that's the can beautifully kicked down the road one more time, isn't it? The bank's second remit, though, behind inflation is unemployment and overall economic stability, to the tune that the interest rate influences unemployment, which it does a bit, but it can't do everything. Fiscal policy is obviously a huge part of that. So they would be bothered by this increase in unemployment and what's been going on in the labour market. And they say plenty about it, including, again, reporting on the drop in vacancies that I noted last week. But in the summary, the language that they choose, which is incredibly important, especially towards the end of the summary as they bring it together, there has been substantial disinflation over the past 2 years as previous external shocks have receded. Well, that's true, but it hasn't been disinflation to target, of course, apart from in 1 month if you count September 2024. But they pat themselves on the back for minimising second-round effects and stabilising longer-term inflation expectations. They also note they're keeping an eye on the wage price spiral, but cost of living increases have stopped that from happening thus far, but they remain vigilant. If you look at just this month and you see wage inflation, yes, it's still in the 5s, but if food inflation is in the 4s, it's not helping realistically. And owner-occupier housing costs are in the 6s, you see where the problem lies. But all this is mixed together in the baskets to show we are still seeing real-time increases in wage, real terms increases in wages at the moment, right? So they're remaining vigilant, which is obviously wise. And they say monetary policy will need to continue to remain restrictive for sufficiently long until the risks to inflation returning sustainably to the 2% target in the medium term have dissipated further. That's how they close the whole summary. But in plain English, as they've been saying for a long time now, these cuts aren't happening particularly quickly. So More of the so what in the long run, and this picture that's been forming in my head with much more clarity over recent weeks and months. The yield curve. I've mentioned it more than a few times over recent years because of some strange behaviour of the curve, although a lot of that shape is now explained, in hindsight, as risk management by central banks, including the Bank of England. This week's image is the yield curve, currently, which is the black line, compared to the yield curve from 12 months ago, which is the lighter coloured line. And it's helpful to show how the story has changed. So you can see that if you look up the supplement on my LinkedIn, you will see that with the appropriate picture on my newsletter section. If you haven't subscribed to the newsletter format on LinkedIn or connected with me, I would really appreciate you doing both of those things. That would be great. Thank you in advance. Quick explainer. The yield curve simply plots the yield of all the government bonds over time. So you've got the annualized yield on the y-axis versus the duration of the bond on the x-axis at the bottom, right? So how long has it got left to run before maturity? That's the duration, right? When the bond is redeemed at its face value. So last year we had what's called an inverted curve. And that's been going on had been going on for a couple of years. Typically a precursor to a recession, almost always correct about a recession. But what all the analysts missed who started calling for one, although in fairness, there was a small one in the US in 2023, although they decided not to call it a recession because they have a more expert-led approach in the US as to whether it is a recession or whether it isn't, right? We had a tiny non-technical one in the UK in 2024 because between May and November, we had 2 quarters in a row where the UK economy did go down. It was in the 0.00s. So it really was a very, very small and non-technical one because technically we look at calendar quarter 1, quarter 2, quarter 3, quarter 4. But we did have a period of extreme flatness. So this risk management measure in terms of tighter interest rates than the natural rate was exactly that. Remember, the natural rate is the rate at which the economy doesn't grow or shrink thanks to the interest rate. It's interest rate neutral, right? The market said it was too high for borrowing, and that's why the nearer term rates were higher than the medium term rates. I know that's difficult to get your head around, but that explains, in my opinion, this most recent historical inverted yield curve. Let me try and translate a little bit. The graph shows 12 months ago, the cheapest debt per annum was the 6-year gilt, and then the 5 and the 7. Pretty good news for borrowers, relatively, especially secured lending mortgage borrowers. Although very few of us will look back at June 2024 and go, "Oh, how thankful I was for those low rates back then." But little did you know, the gilt was just under 4% at 5 years, and it's just over 4% today. So very little has changed, right? The 30-year gilt, which is much more important in the US, although it's their own bonds they look at, not UK bonds, of course. But our curves look very similar. Our pricing looks very similar. There's a 90+% recent correlation between the US bond yield curve and the UK gilt yield curve. Huge correlation. They were 4.6 last year in the UK, 30-year gilt, but today they're 5.27. So that low 5-year rate helped people who wanted 5-year mortgages. The high 30-year rate does not help the US property market. As I've written about earlier on, 7% is pretty painful, and I think most people will be finding significant pain. And if you think about stress tests over the years, stress tests were at 5.5% in the UK. Right, that was a stress situation as it was considered in the 2010s. And we saw earlier on, according to Rightmove, 12 months ago, the average drawn mortgage was 5.01. So within 0.5% of the old stress situation. I don't think anybody should really be thinking that's not particularly painful, right? If you wanted 2-year money a year ago, it was 4.2% on the gilt. And that was a big reduction from where it had been when rates were higher. Now, I think it's probably important at this point to explain the bank's role in setting this price. The bank rate is deemed broadly to be a fair proxy for the 3-month rate, right? The yield curve I've shared on my LinkedIn is actually starts at 1 year duration. But in reality, you can go back to 1 month or even 1 day if you wanted to and plot a yield curve like that. So the base rate is usually very, very close to the 3-month bond yield because in 3 months, it isn't expected to change much. That's the nature of central banking, right? It starts the curve off. And of course, it influences the rest of it. So if you think about it, 2 years has got 8 3-month quarters in it. 1/8 is determined by the bank rate, and then the other 7/8 are influenced by it, but they're not set by it, right? And the further out you get, the less the bank rate has had an influence on that. In 3 months' time, the gilts that are 2 years old today have 21 months left to run. This is quite an important concept to remember. So you could say the bank sets 1/8 of the 2-year rate, but what I'd rather say is the bank has a declining influence, right? The pass-through, there's lots of academic papers been written about this, as you might imagine, because it's pretty important stuff, central banking. The pass-through is actually between 70 and 90%. So you might understand why the 2-year was a lot higher when base rate was 5.25 compared to today when it's 4.25, a full percentage point lower, and that the 2 years are pretty much around a full percentage point lower. Quite as smooth as all of that, but it's one reasonable proxy, right? Remember, the market takes into account what they expect the bank to do, and this is key, right? So when it comes to the 5-year, that level of influence declines more like 50 to 70%. When it comes to the 30-year, make it more like 25%, or a few dozen basis points on the yield. Some of the literature suggests, right? Less than 0.5% of the actual yield is being governed by where the base rate is today. And that makes sense. As I say, the further out you are, the less you're influenced by today's base rate and the rate set for the next 3 months. In the UK, the forecast period is 3 years, which has to be respected. And the people on the Monetary Policy Committee, other than the governor, who can be controversial, is also there to be shot at, of course, are mostly very highly respected and preeminent economists, right? So, in terms of the 2-year mortgage market, most of the pricing is done by the Bank of England, directly or indirectly. In the 5-year market, most of it is done by the market. In the 30-year US market, it's almost all done by the market, right? Now, extend that concept of time, and I'll help you read the story that the yield curve is telling us. So if we consider the 1-year and 2-year curves 1 year ago, the 1 year yielded 4.65. The 2-year yielded 4.182. This is the inverted curve, right? The overall concept of arbitrage, zero risk trading, then suggests that the expectation 1 year ago of the 1-year bond yield today was 3.72%. How do I work that out? Well, I take the 2-year bond, and then I extrapolate 2 years of returns at 4.182. But then in the first year, I'd return 4.65, which was the 1-year yield. Then the remaining year would return 3.72 for me to get to that 4.182. I hope you understand that. It's somewhat complex and abstract, I know. But what is the 1-year bond yield today? If I would have predicted 3.72 1 year ago today, what's the 1-year bond yield today? 3.79. Pretty close, right? Not an exact science, but a pretty good predictor. When would this not have worked at any point in the past? Around any time of genuine crisis, recession, or black swan style event. COVID, Brexit, the great financial crisis in 2008. Otherwise, in stable times, this will be a stable time predictor. Now, the longer out we go, the more time we have, the more we're unsure, or the more likely we are to have one of these black swan events. However, you can see how we can get the picture to tell us a mathematical story. In the normal world, if you remember that, we would expect the graph to shape upwards over time. Why? Well, lock your money away for longer, get a better rate, because it makes up for uncertainty. Seems reasonable. It's certainly the interest rate savings account I was brought up on as a kid when I was taught to save some money, right? Do you want to use term deposits to lock away money for 5 years or more? Well, many do, as they are extra rainy day savings. Some pay interest payments annually or monthly, of course. Some roll up to the end. But at what gradient would we expect the slope to go upwards? It would be fair to say not as sharply as today. Now, this is called the term premium. How much more money do you get for locking money away for longer? It's estimated as between 0 and 1, and often between 0 and 0.5. At the moment, that premium is more like 1.25 for 20 years or 0.6 for 10 years. Why is it outside of that normal range? Well, guess why? Inflation expectations, right? If you know your principal, which is the money that buys the bond in the first place, is going to be worth even less than you thought when the bond matures, then you demand to get a better return for it. Of course you do, right? And demand and supply is what sets that price in the secondary market, which is influenced by the Bank of England, as I've already discussed. So let's do that same exercise for the 1 and 2 year for the 20-year bond, right? What's the 10-year yield today? 4.543. What's the 20-year? 5.168. So what's the 10-year yield in 10 years' time? 5.8. That's the current story, 5.8%. Subject to change, of course. Much more likelihood of a change in 10 years than in 1 year, one of our black swan events or whatever. 10 times as likely, maybe. I'd suggest even more than 10 times as likely there'd be something happening, because it's much easier to predict 1 year away. Do we think there's going to be a major blow-up crisis in the next year? Obviously, we've got geopolitical tensions to consider, but setting those aside, just on the base level economics of the UK, no, there's nothing waiting to blow up on us at the moment, in my opinion. Over 10 years, hey, listen, the state's got huge problems in terms of spending too much and not raising enough revenue, in terms of not growing enough. No two ways about it. Will that manifest over the next 12 months? No, it won't. Are Labour going to address that? Not really. They're trying to grow. That's the best that they're trying to do. But anyway, not meant to be a political statement, right? So why focus on the 10-year yield, though, here? Well, because that's the liquid one. That's the one where most of the money comes from historically, more than any other time period. It's the time horizon that the institutions like. So if that was a reflection of the UK's average cost of government debt in 10 years' time, that would be problematic, to say the least, right? Every 1% on top is an extra 28 billion a year in interest payments in today's money. So an extra 1.5% is another 42 billion in 2025 money that the government spends on servicing debt rather than anything else. Ouch. We need to look at the 5-year, however, for our own purposes. Today, 4.046 discussed in the gilt section of the macro, right? The 10-year, 4.543. So the 5-year in 5 years' time shakes down to pretty much exactly 5%, right? Let's say that the swap rate, that's the swap rate as well, 5%, right? In 5 years' time, the 5-year swap is 5%. We've enjoyed roughly 1/3% discount on the swap in recent times, but let's say that's gone away. We're more likely to preserve a discount, I would say, to be honest, based on demand for the swap versus supply for the swap, because rates are higher, but there's no guarantee, right? At a 5% swap without some major league efficiencies in financing and refinancing and valuations and all sorts of things, which are all possible over the next 5 years, don't get me wrong, but you think that firms would want to maintain margins rather than compete on margin just because cost base had gone down. But the 5% swap puts, as I say this all the time, you add a rough proxy of 2% onto the swap rate, you're at 7% mortgage rates in 5 years' time, right? So normal buy-to-let workable yield under my typical calculations becomes 10%. And for a 75% loan-to-value loan, 8.75% yield would be needed in order to get 75% loan-to-value. Now, that's not the sort of yields we've been seeing. Now, of course, if rents continue to outpace capital growth, and at the moment they are, ONS reports 7% rents, 3.6% capital growth, 3.5% capital growth. Not quite as accurate, because really you probably use new rents against house prices, because house prices is determined based on transactions. They're not based on all of the house prices in the UK and some kind of proxy model of all of those. They're based on transactions. So you probably look at new rents, which are more like in the 3 to 4% range. So yields are flattening at the moment in general, in that rents are only going up about as much as house prices are. But bear in mind, we spent most of the 2010s with rents not matching capital growth by any stretch of the imagination. So we'll have to see. But at the moment, your best predictor for the next 5 years of yield-wise would be flat. Now, that's because, to be clear, rents are going up and capital growth is going up, and they're going up at roughly the same rate. So flat is a fair proxy. Some people think house prices are going to race forward significantly. That would lower yields, which would make rentals much, much more difficult again if the interest rate was indeed sat at 7% for limited company mortgage debt. Now, I'm writing this up and I'm making it official, right, in the supplement, because I keep hearing and I keep being told the same thing. I've been going around doing talks for several years, right, and being told usually by mortgage brokers, you're wrong, you're too miserable, rates are coming down. And I don't apologise for this, right? I don't do this with an agenda. I try to tell the truth. And I think that's the most important thing to do. I'm not employed by a company to say this. I've got my own portfolio to look after. I'm very, very highly incentivized to make sure I get this stuff right. And then I share it with anybody who's interested in watching and listening, right? So that's just what I do. That's my purpose in doing the supplement, publishing it via the YouTube and everything else, right? This is my official first public statement of rates aren't going downwards under the current setup, right? Even myself, I've sometimes been speculating, saying, well, rates might be lower in 5 years' time. That is not what the evidence and it's not what the markets are telling us today. The story today is that rates are increasing over time and that the primary driver is inflation. Now, we might be fine. If inflation is 3%, we might be quite happy because that puts base wage rises at maybe 4 or so, makes it difficult to get under 4, in my opinion. And it makes base capital growth for housing 3% rather than over the last 20 years. Bear in mind, inflation has been 2.82%. House price growth, 3.2. So let's say 0.4 above inflation is a good proxy, or that put cap growth up to 3.4 as a general rule. And it would put rent growth anywhere, if you use CPI plus 1, which is now the social housing metric for the next 10 years, you could put rent growth at 4%, which would be perfectly reasonable because apart from anything else, fast forward to this, not dystopian future that I'm predicting, but let's say we are there, it's going to be hard to buy properties that yield 10%. You're going to be concentrated even more into the north of the country or extremely high yielding areas. It will be very difficult to make a business case to hold rental property with a mortgage in the south. And so the Midlands will start to be affected if 7% is the real number we're going to be looking at. Now, look, this is this week's yield curve. Today's yield curve. This is absolutely happening, right? We need to see what happens over the next 5 years. Will we have one of those black swan style events? Will we see interest rates come down significantly for another reason? But at the moment, and this is what Mr. Trump, I don't think, understands, if you force down the near-term rate, bearing in mind that sets about 25% of the 30-year, it might bring it down a little bit, but the market may well go the other way and say, no, mate, if you're not controlling inflation now, you're not controlling spending, you're not controlling inflation, you're not growing very fast at the minute, you're not showing us the big growth, although the big, beautiful bill could be argued to be continuing to support the American dream and the points of economic growth in the US. Where that growth goes and inequality would be a separate discussion. Of course, you've got to bear that in mind, but if there is growth, it's likely to see consumer spending go up and all the rest of it. It's difficult to understand that, but it's not, there's an earthquake coming. It's don't stay in this game for another 5 years if you think that you're going to be getting interest rates coming down, because at the moment, there's no story of them going down. And if you've waited for years, it's time to cave in and take a rate, right? Because there's no workable prediction in this world, unless you believe that inflation will right itself. And in order for inflation to right itself, largely speaking, you need a pretty cataclysmic economic event which sees inflation go downwards. You see a real slowdown in an economy. So what's going to cause that? At the moment, all we've got, like we've had, I said at the beginning of 2023, what I suspect for this year, my weather forecast for 2023 was treacle. And that's exactly what we've had since 2023, treacle. GDP growth per capita, treacle. Of course, the Labour Party at the moment believe they're fixing the treacle, but even the most hopeful forecasts are maybe 1.8% growth, things like that. This is not going to solve the national debt problem, the deficit problem, and all the rest of it. And if you look to the US, that problem is 5 times bigger. But of course, they have a much stronger credit rating, a much stronger credit worthiness, apparently. Now, what are we saying today? Rates are increasing over time, and the primary driver is inflation, as I've said. I said back in 2020, as I went back and analysed the whole variety of previous pandemics, many of them were hundreds of years ago, 500 years ago, stuff like that. But you still had the big macroeconomic data. So the inflation rate tended to be about 1% higher after a pandemic for 30 or 40 years. Now, does the economy behave in the same way? Do we need that 30 or 40 years? Arguably not necessarily, right? Things are a lot faster these days. Things adapt a lot more quickly. But that was what the previous analysis had told me. Even if that 30 or 40 is 8 or 12 years, it's still a lot of years, right? And we've already got those factored in and baked into all these yield curves and all these forecasts, right? But it's only in the last few months the bond markets have really accepted this and started to price it in. The other driver is the massive amount of government debt the UK government has. So how do you disagree with this position, right? You have to think that you have to think that inflation is going to come back to normal more quickly. Well, I challenge you to show me any of the evidence that is showing inflation is anything other than 3% plus at the minute. And there's no real scope for that to be coming downwards. When wages hit 3.5 to 4, I suspect we'll be more like 4, 4.2 if we're lucky by the end of this year, right? When are they coming down below 4? If inflation is 3, they're not, are they, realistically? If people want real terms, pay increases, it's going to be a struggle. It's going to be a difficulty, right? And what did the government do? Well, they increased government spending in real terms by 3.2% when the economy is only growing 1% if we're lucky. You see, the problem continues, and therefore the debt in the future doesn't look better, it looks worse to bondholders, apart from anything else. Creditworthiness going down. You know that the US credit rating has been downgraded recently because Doge hasn't done the bits that that's thought that it will do. There we go. Right. So it's the huge amount of debt, of course, that the UK government has got. And of course, very much that applies in the USA. You know, we're only at 96, 97% of GDP at the moment. USA is at 123%. The more you've got, the worse you are. But again, I did say a few weeks ago that needs to be netted off against any assets that you have. If you look at Japan, it's got 240% debt to GDP, but it's also got a huge amount of assets. The majority of them being US government bonds, interestingly enough. But there we go. That's the game and the cycle and all the rest of it. So don't stay in the game waiting for lower interest rates over time. Under the current conditions today, they are not coming. You're gambling on a recession. Now, if you've got a view there will be a recession, you've got a viewpoint as to why that's more complex than all the Labour Party don't know what they're doing, which whilst I don't necessarily directly disagree with that on its own will not cause a recession, right? Make sure things in 5 years' time will stack up at 7% because they're going to need to. Don't sit and wait for lower rates to refinance. Some have been waiting since 2022 and burned some serious money in that process. The market is telling us that's not coming. So I think as an aside, this is why I'm not convinced that base rate can go a lot lower than 4%. There's easy short-term reasons why it can, because the economy needs a bit of help, but help is usually temporary. It wasn't in 2009, noted. I mean, in a way, it was temporary, but temporary lasted 13 years, right? But it took a really big blowout for that to be the case. If it's just a few basis points on unemployment or similar, expect a similarly small response to help out briefly. Borrowing from the future to support the present day. However, we, not as soon as the US, you wouldn't think, have got a rough road ahead as we deal with spending too much, not raising enough tax revenue, and ultimately not growing enough, which is a difficult problem to solve and one that won't be solved under this regime, in my opinion. I think we've already seen enough evidence to know that it won't be. Does it mean house prices won't go up? Absolutely not. Higher inflation drags them up more, not less, but a lot depends on regulation. And that's something that I want to talk about next week. Now, I wanted to do a quick postscript this week because I don't want to wait another week before I report on this. On my watch list, very closely at Propenomix HQ, is the OBR monthly commentary on the public sector finances. So what happened in May, because they released that report just a few days ago? Well, 600 million more government borrowing than was forecast. Bit of a fuss made about this in publications like The Spectator that are not big fans of the Labour government. I don't think they're big fans of any government, though, to be fair to The Spectator. However, April was 3.5 billion less than the OBR forecast when it came to borrowing. None of the other forecasts really matter at all, although the bond markets do care what the IMF, the OECD and the likes do say, even though, as I continually say, their predictions are pretty rubbish, in my opinion. But current balance below forecast then is 2.9 billion. That's good news. To be clear, we've borrowed less than we thought we would borrow, and still means that the October-November budget isn't guaranteed carnage as of right. One of the things I remember about the Sunak and Hunt budgets of later times in Sunak's administration was that continually they were coming into those budgets with more money than they thought they would have. That hasn't happened for the last two budgets, right? So Rachel Reeves has not had that luxury. Of course, there's all that spin around the 22 billion black hole and blah, blah, blah. Just ignore all of that. What wasn't going well was borrowed more debt than the forecast said. At the moment, only 2 months into a 12-month fiscal year, 1/6 of the way through, we're currently 3 billion ahead, nearly, in terms of what we haven't borrowed. So not terrible news. But 3 billion isn't a lot in terms of what is it? Well, it's 0.1% of GDP, isn't it? Roughly. So it's not terrible, but it's not going to, it's a thousandth. It's a thousandth of GDP, which is still something, right? It's still triple what they raised on VAT on private school fees, according to them. It's still a significant amount of money to go into most departments. If you put it in healthcare, it gets swallowed up like all the rest of it, of course, but there we go. But it's good news. So I want to share that ongoing good news. It's a shame that May didn't also come in below numbers, because we could have been really bullish then about the upcoming budget. If we're expecting carnage in October, November, I think some people will be. I think the papers will start again. I think Reeves and Starmer have learned their lesson, right? They're not going to come out again and say, oh, we've got a terrible budget coming. Although, to be fair, they said they were going to have a terrible budget, and they delivered a terrible budget. So you could argue they managed expectations and forward guidance correctly. I don't think it was the best way, but maybe it would have been received a lot more badly had they not been. They'd have lost a lot more trust perhaps in the business community, if they hadn't been fairly upfront about what they were doing. Did they really have a choice? A political choice is what I'm saying to you. I don't know. I'm by no means a political animal or a political expert, right? So all depends on growth forecasts. So we'll have another growth forecast in as well. By the time we get round to that budget, the OBR will prepare their forecast, and that's what the Treasury will base and number 11 will base their budget on, right? 2030, 2031 will come into the window. The OBR's growth forecast there, which will probably be quite bullish because recent changes like the National Planning Policy Framework changes have impacted GDP upwards. And the Housing Bank is going to make all this possible if you take a positive view of the world with this latest government effort of financial engineering, these financial transactions that are now coming into the Housing Bank. That announcement obviously wasn't ready for the spending review, but has come in the days since the spending review. So overall, just wanted to share that kicker at the end. So I do think that's one of the most, if not the most important supplement I may broadcast this year. We've still got half a year left and I might have egg on face on that one. But really that message about where interest rates are predicted to be by the market, a very, very liquid market, trillions of pounds of dollars traded in it on a weekly basis, right? Humongous market is saying that in 5 years' time, the 5-year mortgage rate is roughly 7%, not roughly 6% or 5.7 as it is today. Will make a huge difference to your investments. It's going to inform me in terms of doing deals with vendors where I think, well, if I've got to do a vendor finance deal in 5 years' time, I'm going to need to cover 7% rates, right? I'm going to need to know that. Hugely important, right? Okay, so now I'll take a breath. We're at the end once more. Please remember to book your tickets, though, for Thursday's 3rd of July Property Business Workshop. Joint ventures and mergers and acquisitions. It'll be another fabulous day of learning. Great discussion is guaranteed. Rod will be there as well. And hurry, because your early bird tickets have only got a few days left and then we go to full price, right? bit.ly/PBWSEVEN. Don't miss them. There are only a few left anyway. Hope to have a full room. We always get fantastic room of people for networking. There are dinner tickets available if you'd like to have dinner with Rod and I afterwards. Your dinner cost is wrapped into the price, obviously, and it's a chance to have a good chat with us about anything you want to in a much smaller and more intimate setting. The dinner starts at 6 p.m. We're normally away by about 8, so if you're travelling back home, as I will be getting back to sunny Solihull on the train, you can normally do it in one day. Early start, late finish, but it's a great day, right? Now, above all, though, please remember to keep calm. Always come back and listen to the supplement and carry on, because there's going to be opportunities abound this year towards 2030 and beyond. And the risks around at this time, whilst they might feel significant, especially the geopolitical ones at this time, are far less meaningful to the UK housing market than they've been for several years. And of that, I have no doubt. So, good luck.